India's banking troubles began as far back as 2007 and 2008, before the global financial crisis, when a lot of investments were made. Those investments created a lot of bad loans that needed to be cleaned up in order to spur lending. Banks are the most significant source of funding for Indian companies. The banks have stopped lending because their balance sheets were getting clogged with non-performing assets. India's banking system has lost $24.8 billion due to non-performing loans of 416 defaulters being written off, CNN News 18 reported last month. In the last 3 years alone, the Indian banking system has lost more than $26 billion on accounts of non-performing loans of 416 defaulters. Each was owing $20 million or more, all being written off. Roughly, the amount declared as bad loans turns out to be around $80 million per borrower. This is the first time data relating to big loans and the biggest defaulters owing at least $14 million has come to light. The constant outburst in bad loans has prodded the government into stepping in time and again to bail out banks by recapitalizing them. While banks claim that the recovery measures continue even after write-offs, sources say no more than 15 to 20% is recovered. In India, there is no protection to depositors from the government side. India's banking sector has been undergoing a bumpy patch for the last 5 years. The number of non-performing assets, NPAs, has shot up. At its crest, the gross NPA to advances ratio outpaced 11%. Before the NPA crisis hit, banks furnished more than 90% of the economy's commercial credit. Subsequently, any deterioration of banking has a deep and durable shock on the economy. The recent NPA crisis has been followed by a sharp downturn in investment expansion and a compelling economic slowdown. Among the many causes that the crisis has been attributed to, a critical one is the influence of government-owned banks in the system. In India, government-owned banks or public sector banks, PSBs, account for 70% of bank loans. All along the late banking crisis, they were hit worse than private and foreign banks and accounted for 90% of the total NPAs. The PSBs had to make rations for these bad loans. Contributing to the corrosion of their capital, the government had to recapitalize the banks. The aggregate amount of capital infused by the government in PSBs since 2008 to 2009 is $42 billion, roughly 2% of India's total GDP. For a government that's faithful to fiscal strengthening, this is a severe budgetary burden. There are grave institutional concerns with these PSBs, which succeeded in being in 1969 as a result of bank nationalization. For the first 25 years, PSBs benefited a near monopoly in Indian banking with a share of over 90%. The only auxiliary banks were the old private banks that were supposed to be too small to be nationalized and a few foreign banks. In the course of this period, significant modernization of the PSBs materialized under government control. Management structure and human resources guidelines, in addition to coverage and administrations, were standardized. The senior management group became commutable throughout the banks. Following the end of this proceeding, PSBs operated as one body with over 25 different names. In 1991, India initiated economic liberalization and privatization. As part of the various liberalization schemes, new bank licenses were delivered to private sector players who started operating in the mid-1990s. No later than the early 2000s, they arose as possible contenders for the PSBs. As the new private banks began defying the PSBs, shortcomings deep-rooted in PSBs throughout 3 decades under government management became evident. They missed any competing head start. The PSBs came down with poor management. The councils of these banks are feeble and deliver little supervision. Government proprietorship means the banks are susceptible to the impact of politicians and bureaucrats. Political interfering to authorize loans to some connected borrowers is a big issue, particularly in infrastructure projects where the borrowers have a good connection with the government. The PSBs are moreover used as instruments of government plans and programs. This undermines internal governance over recent years. The government has conducted two programs strenuously, the Jan Dhan Yojana and the Mudra scheme. The first is a liability side program where accounts are opened for unbanked customers with few requirements, such as minimum balances. The ultimate is a lending program for micro and small enterprises. While the purpose of both these programs appears virtuous, little consideration has been paid to their commercial practicability. PSBs have been enforcing them without any trustworthy business case. PSBs also have inadequate risk management. Enormous loans are submitted directly to the boards of the banks without being carefully evaluated by a risk management team, a procedure that's ordinary in well-run private banks. Risk management teams in most PSBs have a propensity to be irresolute. The root of the problems confronted by PSBs consists of the government's procedure as owner and manager. These banks are awaited to behave like competitive commercial agencies when facing customers and like spheres of government in other respects of their operating. For PSBs to be competitive, each demands to establish its scheme and give priority to customer sections, geographies, and solutions. Under the uniforming force of government possession, doing so is very complicated. All these organic issues concluded in the acute, ongoing NPA crisis. PSBs undergo incompetence to resolve bad loans. This is partly because public sector bankers have little motivation to recover loans. There are also enormous disincentives. Resolving a lousy credit in a commercially efficient manner, taking a haircut early on and closing the loan, can put the bankers in serious personal trouble with allegations of impropriety. On the other hand, delaying recognition and avoiding any commercially sensible settlement is a relatively safer choice. Consequently, incentives for PSB officers have been stacked against a quick resolution. India is in a deep crisis, and these kinds of news are slowly spread as, eventually, bank accounts will be frozen. The government is fudging all numbers, and the RBI has bailed them out for the moment. But hiding facts won't improve the economy, so the last step will be confiscating deposits. With respect to numbers, India's deposit insurance scheme covers as many as 70% of bank depositors, but there is a considerable grab. Accounts that have less than 1 lakh collectively make up only about 8% of total bank accounts. That means a breathtaking number of accounts retain more than the safe amount. This fundamentally means that a bank failure would be nothing less of an unparalleled calamity, because a depositor would be left with just 1 lakh of what was his entire life savings, which for most people generally amount to multiple lakhs. This is precisely why the FRDI bill worried India. It had a clause that said bank depositors would have to share part of the cost of resolution of a failed bank. In the midst of India's peer economies in the BRICS, the proportion of deposit protected under insurance is way higher. If we compare India with the BRICS group of countries like Brazil and Russia, the comparable insurance amount rises to 42 lakh and 12 lakh respectively. If we compare the deposit insurance limit in India with other countries that are having comparable per capita income, we find that the insurance cover is even unlimited in some countries. India also fares absolutely poorly when the amount insured is seen as a percentage of per capita income. In India, it stands at a miserable 0.7%, while Australia has it at 3.7%, the US at 4.4%, and Brazil at a reasonably respectable 7.4%. One thing, however, must be explained. There is a substantial distinction between India and other markets regarding banking. In India, no scheduled commercial bank has been permitted to go bust since the liberalization. The central bank and the government have continuously guaranteed that a defaulting bank gets purchased before it asphyxiates. Only cooperative banks have failed here. As per data from the Deposit Insurance and Credit Guarantee Corporation, DICGC, the cases of about 350 such banks have been resolved so far for a payout of 4,822 in claims. It is appropriate noting that DICGC is the authority that offers deposit insurance in the country. Hundreds of thousands of depositors have been abandoned in the slope by the scam that surfaced at the Punjab Maharashtra Cooperative Bank. The bank had breached Reserve Bank of India (RBI) standards to lend substantially to one client real estate firm, Housing Development and Infrastructure Limited, which itself is confronting bankruptcy proceedings. The RBI has introduced lending limitations on PMC. Depositors are feeling rage and agony as they learn capital controls have restricted them to only withdrawing the equivalent of $100. With a financial crisis building, the Reserve Bank of India is struggling to reassure the public that the banking sector isn't imploding. It is coming to a bank near you soon. The Punjab Maharashtra Cooperative Bank (PMC) in India has been busted cooking the books and giving false statements on non-performing loans of Mumbai-based real estate developer Housing Development Infrastructure Limited. As Reuters reports, PMC disguised the bad loans using 21,000 bogus accounts, which has freaked out depositors, investors, and government officials. Suits them right to entrust the banks instead of abiding by the tried and actual traditional precious metals. You should have kept all your rupees in silver and gold. You can never trust a bank or your government. The crisis development at PMC Bank is but the tip of the iceberg of more substantial pending issues in India's banking sector. The roots of the crisis in the banking sector on a large scale come back to the unresolved problem of non-performing assets, or NPAs, which were amplified in the case of cooperative banks as a result of lax governance and a risky business model. Regrettably, the Reserve Bank of India's procedure seems to be to bolt the barn door after the horse has escaped, and by enforcing harsh withdrawal restrictions on depositors, recently relaxed, inevitable when problems have been allowed to fester. Those who suffer are primarily the poor people tempted by the higher deposit rates that cooperative banks propose. The Fed and every other central bank all over the world is perpetuating a fraud on such a gargantuan scale it's inconceivable. The chainsaw juggling act is on the verge of coming to an end. 401ks and IRAs will be the first to vanish entirely. There will be bail-in. Any customer with under $100,000 will lose 40% of their assets. Anyone with more than $100,000 will lose 60%. The FDIC would be discontinued nationwide, most presumably by a secret act of Congress. Would that Americans could understand the importance of strengthening all finance business into an oligopoly of the too big to fail establishments, firmly regulated by their own past employees, all in a government-sponsored cartel, all of it subject to political impact. This is a lesson for people everywhere. Your money in the bank coffers is not really your money. It belongs to the bank and ultimately to the state. Capital controls, bail-ins, and it's all gone. This can't happen if you take ownership of either gold or silver or even Bitcoin. This is the lesson to be learned here. Also, history shows us that India is the testbed for anything nasty the powers that be have planned for us 99%. It happens first in India, lessons are learned, the people studied. Then it's rolled out in the West. The Depression is coming soon to a city near you. Here it comes. It's hitting already in communist China, now India, and you're getting a taste of it in the US as the repo rates are going crazy. The safest place is your mattress. This is just a sneak preview of what is coming to the entire world. I'm not joking when I say to stock up on 50-pound bags of rice now. For the banks to do well, the economy has to grow and thrive. Then only the investments will give decent returns. The banks will be profitable and hence the deposits will be safe. The poor governance from Modi and PJP in the last 4 years has been a disaster to the economy. There are no real signs of any revival of the economy. The Modi and PJP in the previous 4 years have been a disaster for the economy. There are no real signs of any improvement in the economy. The Modi government and its cabinet are on their own trip with no care of all their flop shows. Make in India was a massive flop, and no review or study was done to understand why it was a failure. Never in the last 50 years we have had such negative sentiments.